On ET Now.
One month on, the impact of the country's biggest economic decision remains unclear, with nearly two-thirds of the circulating cash back in the banking system. Prime Minister Narendra Modi is battling critics questioning the effectiveness of the crackdown on black money. Slowing economic growth and persistent long queues stain the government's narrative. Prime Minister Modi thanks the public support for the note ban, reassures people that it's short-term pain for long-term gain. Also urges people to embrace digital transactions and go cashless. PayTM stands for Pay to Modi, quips Rahul Gandhi as he keeps the heat on the government. The Congress Vice President slams Prime Minister Modi, saying that the note ban was a foolish move, not a bold one. The political bickering over demonetization remains caustic and disruptive. But with an aim to incentivize cashless payments, the government announces a whole set of SOPs to encourage digital payments, including discounts on fuel, insurance and railways. As the demonetization experiment completes a month, Railway says it won't accept old currencies from the 10th of December. The government gives tax breaks and card payments up to 2,000 rupees in a bid to push small consumers to digital transactions. Hi there, you've joined us right here on Smart Markets. I'm Tanya Bharadwaj. That's, of course, the top story that we're tracking for you all evening. But here's what else is grabbing headlines. Global markets have edged up as European Central Bank extended stimulus by 9 more months, but at a slower pace. Euro has hit a 3-week high against the dollar, but the euphoria has ended soon after. Sensex surges over 450 points on the Lal Street alongside other global markets as investors hope for added stimulus from the ECB, which of course wasn't quite meant to be. Global cues did though help the Lal Street today overcome somewhat the disappointment from the RBI yesterday. The telecom tariff war intensifies. Airtel offers free voice calling on prepaid with substantial data benefits to take on Reliance Jio's freebies extended till March next year. The letter wars between Cyrus Mistry and Ratan Tata draw SEBI's attention. Market regulator asks audit committees of listed companies to investigate breach of corporate governance. Also joining in on the show as every evening for all the market stories, we'll of course chat with Ajay right here in the studios, and KK is standing by with an eye on all the national and political developments. But first, we'll start things off with the big global development where the European Central Bank, or the ECB, has said that it will scale back the pace of its monthly bond purchases from 80 billion to 60 billion pounds a month from April next year. Policymakers have said that they will stay the course with QE until at least December. Of course, that's longer than markets had expected, and still stood ready to extend and expand their measures if necessary at all. First, let's get a word in from ECB President Mario Draghi.
As to preserve the very substantial amount of monetary support that is necessary in order to secure a return of inflation rates towards levels that are below but close to 2% without undue delay. Monetary policy is focused on maintaining price stability over the medium term, and its accommodative stance supports economic activity. The implementation of structural reforms, in particular, needs to be substantially stepped up to reduce structural unemployment and boost potential output growth in the euro area.
Okay, let's check in on what's happening as far as, stocks on Wall Street are concerned. These are, of course, initial ticks, and mostly they are pretty pretty flat after the ECB's, interest rate decision, which of course didn't quite change. The ECB has left its rates unchanged. But remember, the action to a large extent is happening in the European markets. And Ajay, this is pretty interesting because, while there was expectations that we will see the ECB actually go ahead and, extend the time period for their QE, what perhaps was not expected is that they would pare back a little bit on their bond purchases.
Actually, Tanya, it's very mixed kind of a signal which has come from ECB today, because you're right. On the one hand, they've extended the duration, but they've trimmed the amount of purchases. So that actually is kind of giving a very mixed signal. And that is what the reaction in the market is. If you solely look at the stock market reaction, they may have gained after that particular announcement. But if you look at the currency and the bond market reaction, euro actually weakened versus the dollar. And most of the strategists do believe that this kind of a outlook, the strength in dollar may very well continue. On the other hand, German yields have also spiked. So bond and money market reaction in Europe is actually pretty different from the stock market reaction. And if it really was so dovish, it did not really have any rub-off effect as far as the US market go. They in fact have opened slightly flattish. In fact, traders over there are consuming the jobless data, which has come slightly on the lower side. Oil is steady, so no Q coming in from oil. In fact, traders are now looking out for the meeting before the next week. Meeting is scheduled between the OPEC and the non-OPEC members, and expectations are that OPEC, despite of having agreed to a production cut, may very well let the market adjust automatically. So that again will be slightly bearish for crude. So that's the reason why the global market scene is slightly very mixed right now. Europe is having a party purely on the stock market side, but rest of the places things are slightly sluggish.
Oh, absolutely. And let's get an expert's take on things. Joining in on the phone line, we've got Gurraj Singh Sangha. He's a senior global macro portfolio manager, and he joins in on the phone line from New York. Gurraj, good evening to you. Top story right now: ECB extending QE to December 2017, but also trimming the pace to 60 billion, pounds a month. What would you call it? A dovish taper or a hawkish easing?
Well, that's a very good point, and Ajay mentioned that as well. It's I would consider it mixed, as you correctly characterized. The market seemed to be expecting a continuation of the current pace, and the initial headline suggested a tapering, but reading further indicated an extension. So the net amount is an actual increase in the total QE of about euro 540 billion versus approximately 480 billion euro initially was expected. So I think that accounts for the initial strength in the euro, and also the subsequent reversal quite dramatically. The other interesting thing is the ECB indicated that they would purchase, as part of their asset program, bonds yielding below 40 basis points on the negative side, which was something that the market was thinking about as a potential add-on, and that has accounted for the sharp expansion in the German yield curve spread between the 2-year and the 10-year, as if you may have noticed, German 5-year yields went from around negative 20 basis points and immediately dropped to below negative 40 basis points, in line with what the ECB was saying. So net-net appears to be somewhat confusion on their part, and perhaps indicating that they want to eventually taper, but initially be cautious.
Right. Gurraj, what are your thoughts on the dollar? I mean, the dollar index has been pretty much trading pretty steady, went all the way up to 103.5, 104, came back, but strategists, we read about and talk to are saying that probably the growth trend over there may continue, which will reflect it best in dollar, and hence the strength over there. What are your observations? Because strong dollar actually wouldn't go down well for the economy of United States, isn't it?
Right. The dollar has, as we've been discussing over the past year, has benefited quite a bit from the turmoil in Europe, as well as the continuous shift in policy in Japan. And essentially, of all the major currencies, although it has its own flaws, it's ended up being, the best choice and has attracted capital flows. Given what happened in Europe this past Sunday with the Italian referendum, which was largely expected, but adds another bit of turmoil in Europe, and the upcoming election in France and Germany, both of which appear to be further indicating the end of the European sort of socialist policy and a move toward more nationalistic mindsets, with a large chunk of the population looking toward potentially leaving the euro situation. That is probably going to continue to support capital flows out of Europe into the U.S. And similarly, with the Trump administration surprise victory, and Trump indicating in a somewhat protectionist mindset, that is probably going to support, initially at least, capital flows into dollar assets. But my best estimate is somewhere around the middle of 2017 is when, as you correctly mentioned, the strength of the dollar is going to start to weigh quite a bit on U.S. growth, given its current structure. And that shift at that point, it should start to weaken the U.S. economy, although it's currently even on a somewhat weak foundation. But at that point, it should become much more dramatic. And then we start to see shift in capital flows out of the dollar into the other major currencies.
Mm-hmm. Interestingly, right now, as we speak, euro actually is trading lower by 1% and dollar index is higher by 1% after the brief whipsaw it actually happened. The other thing I wanted to talk to you about, Gurraj, is the way portfolio money globally is moving out of bond market and moving into stocks once again. They say unofficial estimates that number could very well run into billions of dollars, and bulk of that may be going towards the US equities, and probably that's the reason the broader market, the index in the US is already at record high. Benchmarks are also doing the same. What are your thoughts on this reallocation of money?
Oh, absolutely. That's very correct. The total bond market, the total amount of money in the bond market globally is much, much larger than the total amount in equities, probably by about a factor of 10. And given at least in the U.S., with the rates being so low for so long, it's forced even domestically pension funds and large institutions with long-term liabilities to move capital out of very low-yielding assets such as bonds, in some cases negative, into potentially higher-yielding assets such as equities, given that there's still some amount of risk. And that globally, that trend is also seen to occur because yields are so low. They're at one point 12 trillion in debt was yielding negative rates, and therefore it forces managers to stretch for yield. And eventually, the thought is, if we accumulate some somewhat safe equities, sort of the big cap large stocks globally and primarily in the U.S., given the political backdrop we talked about, it's allowed for capital flows into equities out of bonds. Now, bonds, given the yields have backed up quite dramatically since the Trump victory, eventually that's going to start to weigh on the attractiveness of equities versus bonds. But I think that point is a bit later off, not at this time.
Right, Gurraj, really one last question, and there seems to be a little bit of a worry in the market after the ECB decision today that the European Central Bank could end up in a bit of a taper tantrum like the Fed did in 2013. Is that a risk, you think, that's sort of rearing its head?
Absolutely, and you correctly pointed out as well that the problem that the Fed faced when they started to taper was that they seemed to indicate that as they began to taper, they would eventually raise rates, in a sequential fashion, and they realized that the U.S. economy just wasn't strong enough to go on that trajectory. I think the European Central Bank is in a similar box in that once they start to taper, if in fact they do, which I don't think they're going to at least anytime soon, they're going to realize that the European financial institutions are far weaker than they appear to be at this time, given that yields were so long and European financial institutions gathered together quite a bit of sovereign debt. And then if they decide to taper, they'll realize that it's actually going to become much more problematic and probably force them to stop right away and actually end up expanding their QE programs.
All right, Gurraj, we'll leave it at that. Always nice chatting with you. Thank you so much for taking time out for us. Let's move on.
Thank you very much for having me.
Thank you. Let's put the focus to our markets then. And actually quite a comeback for our markets. You want to pull up the intraday charts for the Sensex and Nifty. You'll know what we're talking about. The Sensex staging a spectacular 450-point rally. Well, the Nifty is back above 8,200 with 8,250 clearly in sight. Of course, to a large extent, we were riding on the global momentum ahead of that ECB meeting. So, Ajay, I suppose it would be interesting to see what becomes of things tomorrow. But today you saw some pretty decent broad-based buying, you have to admit.
Well, Tanya, it was an extremely surprising rally in today's session. No market participant we speak to, many offline as well, were expecting that kind of a 150-point rally on the Nifty, which is the biggest single-day up move we've seen almost in 8 weeks. A combination of covering of short positions and, of course, some value buying coming in. In fact, if you look at the market today, it has taken out that 8,200 sticky zone or resistance, if you will, which we were actually facing in the last several weeks and were finding very difficult